prior to the events that unfolded in February and March of 2020, I was holding on to a lot of cash. My portfolio at any given time would have had between 45 to 55% in cash and the remaining percentage invested in stocks in the stock market. And most recently, as of February 2020, my stock portfolio had 65% in cash and the remaining 35% invested in the stock market. Yes, that is correct. I had 65% of my stock portfolio invested in cash. So how did I know to be sitting in so much cash prior to a black swan event, an event that is entirely unpredictable that sent the stock markets in the US and Australia down over 35%? Well, in today's video, I'm going to explain how. But first, let me explain to you what my investment strategy is, because in order for you to understand why I made the decision to not invest more money in the stock market, why I had so much cash, you need to understand the strategy that told me, the rules of the strategy that told me that I should not be investing more money in the market. So as simply as I can explain my strategy, it is to buy great businesses that will generate me a high return. And of course, that is overly simplistic, and really that should be the goal of everyone who is investing in the stock market, is to find a great business that can safely generate you a high return. But to dive a little bit deeper into what I mean by that, when I'm saying I need to be confident that I can generate a high return, I mean that I need to be able to estimate the future cash inflows that that business can provide for me. What am I going to get out of this business over the next 10 years in the ways that a shareholder or an investor makes money in a business, which is through the stock price going up, through the value of the business going up, that is, and through dividends. So for example, let's say that I use my investment strategy in order to find a business that I am very confident will be a great, thriving, strong business over the next 10 years. And let's say based off that, I'm able to figure out that I can reasonably expect to get about $100 per share out of that business over the next 10 years. So I think that I can most definitely, I'm very confident that I can get at least $100 per share out of this business over the next 10 years. So what does that mean? Well, it means that there is a limit to how much I'm willing to pay for that business. I certainly wouldn't be willing to pay $110 per share, because if I think I'm going to get $100 per share back over the next 10 years in terms of the stock price and in terms of dividends, then I would definitely not be willing to pay more than $100 per share. But I also wouldn't be willing to pay $90 per share, because I have in my mind a return that I want to make. So for example, if I wanted to make a 15% return, which is the equivalent of 4 times in your investment, 4x over a 10-year period, then maybe I would be willing to pay something closer to $25 per share. Because if I paid $25 per share and then I got back $100 per share over the next 10 years, I have 4 times that investment. I've multiplied that investment from $25 to 100, 4x, which is a 15% compounded return. And in reality, I probably wouldn't even be willing to pay $25 per share, because if I'm targeting a 15% return, I don't want to just pay $25 if I'm expecting 100, because I want a margin of safety for errors in our valuation. This margin of safety term was originally coined by Benjamin Graham. It's also used heavily by the likes of Warren Buffett, Charlie Munger, and many other investors. So in reality, if I thought I could get $100 per share out of a business over the next 10 years, I would probably be willing to pay something closer to $12 to $15 per share for that business. But essentially, following that strategy that obviously goes much further in depth than what I just explained, but you can check out some of my other videos if you're interested in learning more. But following that strategy, I have a small list of businesses, about 10 businesses, that I thoroughly understand, that I think are great businesses, and that I've been able to put a number on how much cash I think I can get out of those businesses over the next 10 years. So I had my list of great businesses, I figured out what I could reasonably expect to get out of them over the next 10 years, and based on that, I was able to figure out what price I'm willing to pay so that I could make my 15% return and of course have a margin of safety for errors in my valuation. And that was the situation I was in leading into 2019 and 2020. And throughout 2019, what I found is that all of the businesses, or at least most of the businesses on that list of businesses that I thoroughly understand, they were overvalued. Their prices were higher than what I would be willing to pay in order to make a high return. So throughout 2019, I think I made two very, very small investments throughout an entire year for someone who does this full time. I research companies, I create educational content related to investing full time, and I found two opportunities to make very small investments. And of course, I've been always setting aside a set percentage of my income every single month or every single week or whatever. I set a set percentage amount aside and put it in my investment portfolio. So while I wasn't making many investments, and while my income was coming in and going into my stock portfolio, the percentage in my portfolio that was cash was consistently going up. And I think this is a good time in the video to discuss a major piece of philosophy or advice or a problem that people face when they're investing, when they're picking individual stocks in particular. And that is that the investor's biggest enemy is himself. Now, I can't remember exactly who said this. It was either Warren Buffett or Benjamin Graham, or maybe it was some other very successful investor. But it is the most true statement, and I felt this very strongly throughout 2019 because I love investing, and to not be able to make many investments, to make two small investments, I think one was in March and one was in July or something like that, throughout an entire 12-month period was excruciating. There was so many times where I was so close to just buying into a business and thinking, who cares what price I pay for this business? The stock market's just going up so much, I'm missing out on all of this great returns. And I swear, if I had seen one more green day throughout 2019 or throughout 2020, I feel like I would have just cracked it and just thrown a bunch of money into the market, because that is what weighs on you when you're this kind of investor, is that you need to have the discipline to realize that if you overpay for a business, you might benefit in the short term like you did in 2019. If you overpaid for a business, your returns in 2019 might have been amazing and you might have felt so good about yourself. But 3, 4, 5 months later, now you're paying the price because you didn't have the discipline to wait. And I think that is probably, I mean, there's so many huge investors, very successful investors, that say that the analysis side of looking at businesses is not even the most difficult part of investing. It's having the discipline in order to wait for those businesses to get to the right price and making sure that you're making smart investments, not just following the crowd and jumping in and sort of trying to ride the wave while it's going up. But fortunately, then came the payoff. The stock market in the US and Australia and many other global markets fell 30 or 35% in the space of about a month, really. And I don't say fortunately lightly, because the timing of this crash is not something that I predicted. I just knew that I couldn't overpay for businesses and that there would be some point in the future where those businesses would be at a more appropriate price. And that just happened to come in early 2020 over the past month or so. And I've been buying a lot of stocks over the past month or so. So I added up some of the trades that I've made over the past month, and I've actually invested more money in the past 3 weeks than I had invested in 2018 and 2019 combined. So I looked at all my trades, 18, 19, and then the last couple of weeks. And the last couple of weeks, I have been pushing money into the stock market. And the reason isn't because the stock market crashed. It wasn't that, oh, it crashed, let's now buy stocks. It was that the businesses that I had already determined were going to return to me a certain amount of money in the future, and therefore I had a price that I was willing to pay. Those businesses became, their prices moved into that spot. So it wasn't that I was waiting for the market to drop 30%. I was just waiting for the prices of these particular businesses to get more attractive, and they did. And I made some investments. And now, not all 10 or so businesses in my short list, are at the right price. There's still businesses that are overvalued, but enough of them became cheap enough that I could start investing more money into the stock market. And I recently just checked my cash position. In the space of about a month, it went from 65% down to 35%. So I am now much more invested in the stock market, although I do still have a little bit of cash around because I'm hoping that some of those other businesses will become cheaper and I can start making some investments in those businesses too. So what is my plan now? What do I do from here? Well, 35% cash is still quite a substantial cash position. It's actually a lot more than I guess what a typical professional advisor would suggest that you have in cash, particularly if you have an investing horizon as long as mine. And it's also important to keep in mind that 35% cash position will be going up as my business generates cash flow and I put some of that money towards investments. So that 35% won't stay stagnant. If I don't make any more investments over the next few months, that will probably rise to 40% or to 43% or something like that. So I still have quite a bit of cash, and the reason why is because I still want to make some investments in other businesses that are just not at the right price yet. And even some of the businesses that I were investing in, some of the businesses that I picked up over the past few weeks, their prices bounced back 70 to 100% almost immediately. So some of them were at good prices and I started making some investments, but then they jumped 100% and they're no longer at that price anymore. So I'd need to see them come down further. So I'm certainly a lot more happy with my portfolio in 2020 than I was in 2019 because, as I mentioned, I was on the edge of my seat wanting to put money in the market. But now I'm very happy that I have a good proportion of my portfolio invested in great companies at great prices. It's now just going to be a matter of whether the stock market goes up and those stock positions become a bigger proportion of my portfolio, because remember, if the stock proportion of my portfolio, the 65%, if those stocks go up, then that 65% stock will become a larger percentage. It might go to 70 or 80 or 85%. But if the stock market goes down, then I'll deploy some more of that cash. So that's where I'm at right now. And just to, I guess, summarize again, it really just comes down to whether the businesses are going to be safely return to me a good return over the long term. That's all I care about. I don't care about what the stock price of these businesses was a year ago or 4 weeks ago. I don't care about any of that. I care about what I think I can get out of these businesses in terms of cash flow, and I therefore put a price on what I'm willing to pay for those businesses. So if you want to learn more about this investment strategy that I didn't really go into any detail at all throughout this video, then I suggest that you hit subscribe and check out some of my other videos. On the main page of my channel, you'll notice there's a playlist that's called 4-Step Stock Analysis, and it also says Start Here. If you go through those videos in order, I think there's about 14 or 15 videos there. That will give you a nice summary that goes for a couple of hours explaining what the strategy that I use is and how you can start going out and implementing it. So if you enjoyed the video, make sure you leave a like. Let me know your thoughts down in the comment section below. But for now, I'll see you guys in the next video.